This is our Forex blog for August 20th, 2013, and I'd like to showcase what I consider some of the easier ways of trading. These are our currency indexes, which give you a wealth of information at a glance. You can see, for example, what each individual currency is doing visually as if it's a chart. You can see double top right here in the dollar. You can see it broke out over the previous day's high and then acted as a support area. Once it came back underneath the previous day's high, it's very likely to trend down. You can see the euro, for instance, went from underneath to above its hourly moving average, went to our upper containment bands, a place where it's likely to reverse, and it did. It pulled back, found support at the hourly, and this is a wonderful place to be buying it here at 415, and you want to buy it versus whatever's the weakest. We basically trade with the trend until the market goes statistically too far, significantly above our outer white containment bands is a decent place to, get out of the trade. And you can see when this broke out right here, the dollar has already been trending down. Ideally, when one currency has a pullback and then starts to shoot up, you can see another currency immediately break down. The yen is still above the upper containment bands, and it's gone up too far. So you could look at a euro-yen buy around 415 at that time. Let's bring that up and look at that starting off. And guess what? At 415, 410, 420, you can see that this one shot up. You have a nice little flag pattern right here, and it proceeded to go up for many hours after that. You can see, you probably would have, if you had a trailing stop, got out of it somewhere around here for a nice 40 to 45, maybe 50 pip profit, and then you're waiting for a pullback. This is a huge move up, so you might want to wait for a 38 to 50 or 62% retracement first. This is pulling down into the fib area. You buy the breakout of the trend line, and you can see that one went up about 60 or 70 pips. And let me just draw the fibs on here. You can eyeball where the fib areas are. You can see it made a perfect 50% retracement there. And typically we use range bars to get into these trades. Now the dollar was already falling, like I said, but the euro broke out to the upside. So at 415, this one's also likely to be a good one, although not necessarily as good as the yen being too extended at that time. You can see it also has a nice little flag pattern right here. It broke out, went up about 15 pips. You buy this little pullback right here, and you would have got out of that here. If you draw your fibs on this whole move, this is probably a 38% retracement. You got into that trade, it went 40 or 50 pips, and this is just, in my opinion, one of the easiest ways of trading. Now ideally, you're trading currencies like the euro that's very strong on all time frames against a currency that's weak on all time frames. So let's find another one that might be much weaker, and then during this pullback right here, it had gone up maybe to a resistance area and stalled. Now here, you can see a currency like that. This one's pulled back. Now the only downside with this is it's extremely weak and it's underneath its lower band. I would have preferred, my ideal trade is to find a strong currency that's pulled back to support, a weak currency that's gone up to resistance, maybe to the hourly right here. And so when a strong currency pulls back and it has support, a weak currency rallies up and hits resistance from above, that's the ideal place. Now this one is a little bit too extended, but it doesn't mean you can't watch that currency and have a light Euro-Australian trade at that time. So as you can see, this one wasn't as spectacular as the other one because the Australian was down too much. It did break out here and went up a little bit. You bought that pullback right here, you might have made 20 pips. You bought this little pullback, or this pullback. The last one finally went up, but it was 4 hours later. And that's the main reason why we try to use the containment bands. You want to trade currencies that are inside their bands. That's why buying the euro versus the Australian made sense. This one was strong on pullback. The yen, it was just exploded up and it's likely to pull back, which it did, see, very significantly. And you can see right here, the yen was extremely strong, way above its upper containment bands, pulled back to the hourly. The Australian finally got some kind of a bounce out of this. And so at 6 o'clock, selling the Australian yen makes sense. Or, you basically want to look for sells in it. Whether there are sells or not, you know, time will tell. But the point is, a little bit after 6, or actually it's a little bit after 5, looking at this chart, you can see you have a pullback up from the lows, and your stops right here, and it went down a little bit, but this is the kind of high probability trade that works, you know, a very high percentage of the time. You know, you may not always catch 20 to 50 pip wins, but most of the time you're going to get something for your effort versus, you know, getting stuck with a trade that's, you know, doesn't work out. Now here you can see the euro's up too much. This one's starting to find a little bit of strength, pulling back up off the lows. And at this time right here, you can see this one's above its upper band. This one's near its lower band. At 5:15, 5:30, it's pretty high odds that the Euro Australian will pull back a little bit. And if you look at this chart, you can see that it did pull back, and it did pull back again. So whether you're a trend trader or a counter trend trader, you can use our tools for very high probability. You can also use a tool called the perfect oscillator. I spend all my time working on systems right now, so I don't have the most time to do in-depth classes, but typically anytime this hits a plus 80 level, you're going to get a reversal. The minus 80 level, you typically are going to get either sideways action or reversal up. Notice above the plus 80 level, and it pulled back. Plus 80 level here, and it kind of went sideways for hours. And minus 80 level here, it went up. Plus 80 level right here, it went sideways for 2 hours, or hour and a half, hour and 15 minutes. These plus and minus 80 levels are extreme areas for reversals. And I'm going to end today's blog going over the automated systems I'm working on. We're not going to be releasing automated systems to our traders because the brokers that we have integrated it with are more institutional, and most of our traders only have 500 to 1,000 or 2, obviously way below the minimums. However, most people, when they're trading, you know, just want to get signals, and they can place the trades with whatever brokers you're with. So that being the case, you will see this is a work in progress. I've spent the last 3 or 4 months focused on swing-based automated trading systems, Fibonacci areas, buying and selling support resistance, breakouts of support resistance, and using our statistical tools for confirmation. This also looks for double tops, double bottoms. I'm going to go ahead and add the signals here so you can see how they work. And I've added our value areas on here, which typically show you where the markets are super strong. And you can see I automatically pick up all the swing areas. And so anytime the market makes a higher swing than before, and the lows are higher than before, that's obviously an uptrend. That's the main concept for how this works. I also have our hourly statistical highs and lows on here. And you can see that when you have a trend up, if all you do is focus on, you know, waiting for pullbacks and buying those pullbacks, you know, obviously this is the first one here that failed, but the majority of the trades did quite well. Or, you know, this is getting into the dead area of the day. This is a range bar chart, but you can see, you know, pretty big move here, astronomical move here, very nice 25-30 pip move here. Obviously this is going to be a 6 pip loss. And when you have wins that are so much bigger than your losses, look at the wins, significant. Obviously you're never going to catch every pip, but if you trailed your stop, you might have got out of this trade right here. That's a very big win compared to how much you lose when you're wrong. And that's the key to trading. That's all you got to focus on. Doesn't matter if you're right 35-40% of the time, or on extremely good days 60 to 90% of the time. If your wins are 20 or 30 pips, or if you get one 20 or 30 pip win and the rest are 5 to 15 pip wins, and you're losing 5 or 6 pips when you're wrong, you should do very well as a trader. That's it. That's all you got to focus on. So that's it for today's blog.